There is no interest. There is very little liquidity in the silver futures market as well, which means that prices of gold and silver are going to get a lot more volatile, not as volatile as the dollar itself, or as volatile as tech stocks are going to become. Silver and gold are still going to be relatively less volatile than other derivatives. But as the decoupling progresses from the futures market, we're going to see some huge swings.
Gold has corrected down, and the stock market has remained relatively steady, even though it's been going down. But up until 2, 3, 4 years ago, it was trading above 20, and I think we're going to 1-to-1.
The precious metals market is entering a phase of extreme decoupling as liquidity in the silver and gold futures markets hits historic lows. This vanishing open interest suggests that the paper suppression mechanism is failing, clearing the path for a violent move toward a 1-to-1 Dow-to-Gold ratio. Farber, the endgame investor, and Innecco, creator of the MarioInnecco 64 channel, highlight that while tech stocks and the US dollar face massive impending volatility, gold and silver remain the most stable alternatives in a fracturing derivative system. Their analysis points to a significant structural shift. Silver futures liquidity is currently at its lowest level in over 20 years, even as gold maintains a steady continuation pattern despite recent corrections. As the decoupling from the futures market progresses, the transition from overvalued paper assets, which traded above 20-to-1 relative to gold just a few years ago, toward a 1-to-1 valuation, represents the ultimate destination of this macro cycle. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Here, guys, is the chart that shows you that the gold price is decoupling from the gold and silver or the gold futures market. Gold open interest and price no longer correlate. We have a fluctuation in the gold price between $4,000 and $5,400. That's a $1,400 fluctuation area. And we see here that the price is going up and down since February, since the top here in gold and silver. This is gold specifically, but you can see here since then, open interest has collapsed to around 400,000 contracts, and the price has been going up and down wildly from about 46 or 4,400 down here to about a top of 5,500, 5,400, and then a bottom again of around 4,000, maybe 4,100, and then we're up here to about 4,800 again. And you can see here in the correlating open interest numbers, these are these bars down here, you can see pretty easily that the open interest hasn't really gone much of anywhere from February to the middle or the end of March. And it has fallen from about 400,000 contracts to now about 350,000 contracts. And during the time when it has fallen from 400,000, 350,000, which hasn't been replicated since the 2008 financial crisis, mind you, the price has actually gone up. So the price is going up on falling open interest. It is wildly zigzagging as open interest stays relatively steady, which means that the activity in the futures market in gold is not really affecting the price so much. We're seeing a withdrawal of liquidity from the contracts, and that is making the gold price a lot more volatile, and it's going to get worse as these markets continue to decouple. There is no instant decoupling. It is a gradual process, and it appears to be happening now. Now, looking more deeply into the open interest situation relative to the price, you can see here going back to 2008. This line over here is the 2008 bottom in open interest, this horizontal line over here. And this is where we are now at about 350,000. We're actually at even below this now. This is about 360, 370,000. And we've gone below that to about 350,000 now. So we are about over here where my pointer is circling. This is extremely low. This has not been hit since 2008 over here. But you can see these rectangles that I drew over here show you that in each major rally since 2008, since before the financial crisis to now, you can see there was a rally here with the price moving higher. This blue line is the gold price moving substantially higher. And here you can see a peak in open interest up to about 600,000 contracts. You can see the same thing here from the 2008 bottom until 2011, that open interest rocketed from about 280,000 contracts to about 700,000 contracts. And you can see the same thing here at the beginning of the bull market after the 2015 bear market bottom. In 2016, the price went up from about 1054 to about, what is that, $1,400. And open interest spiked from about 400,000 to 650,000 contracts. Same thing over here in 2019. Until the 2020 lockdowns, there was an all-time spike, all-time high to about 800,000 contracts in open interest in gold contracts. That's the amount of contracts that are open in the gold futures market. But here you see something different in the red rectangle. What is that difference? You see this enormous spike in price from $2,000 an ounce to about $5,600 an ounce. That is more than a doubling. And what has happened to open interest? It has gone basically nowhere on net. It was about 450,000 contracts at the beginning of this rally, and now it is even lower. It is about 350,000. We have actually lost about 100,000 contracts as this rally has progressed. So you can see on a long-term time scale, or I mean, a medium term at least in the last 2 years, that price has decoupled from the futures market over here. It is very obvious when you look at this comparative chart. Now, what about silver open interest? We can see here I drew the black line where we are now at about 115,000 contracts. We haven't been this low since also around 2012, maybe. I didn't go back that far on the chart here, though I think the last time we were at this number of 115,000 was around 2012, and we are substantially below the low and open interest that happened post lockdowns when the COVID era began. There is no interest. There is very little liquidity in the silver futures market as well, which means that prices of gold and silver are going to get a lot more volatile, not as volatile as the dollar itself, or as volatile as tech stocks are going to become. Silver and gold are still going to be relatively less volatile than other derivatives. But as the decoupling progresses from the futures market, we're going to see some huge swings. Gold miners refuse to decline in gold terms. This is, I think, one of the biggest proofs that we are nowhere near a bear market in gold and silver. You can see here that how have gold mining stocks been acting in gold terms. They are still near their highs, meaning this is an inverted chart. So the lower you go, the more expensive gold stocks are in gold terms, meaning how many ounces of gold does it take to buy one share of gold stock or gold stock index, in this case, the Huey. So you can see we're right near the bottom here. So we're right near the highs in gold stocks priced in gold. The fact that this has not gone up as it did during the bear markets of 2015 and the huge collapse in gold mining stock shares in 2020. You can see that over here. And there was another bear market in gold mining stocks from 2020 until 2025, actually. But we're back down over here at 5.78. And the low, meaning the high in gold stocks relative to gold, is at about 5. We are very close to that, and we could hit it any day. This is not a bear market in gold stocks at all.
The gold and silver markets are currently undergoing a historic decoupling from the paper futures exchanges, a process that is fundamentally altering price discovery. For the first time since the 2008 financial crisis, gold prices are experiencing massive volatility, swinging between $4,000 and $5,400, even as open interest collapses. Historically, major rallies have been fueled by spikes in contract volume. However, the recent doubling of gold's price occurred as open interest actually fell from 450,000 to 350,000 contracts. This withdrawal of liquidity suggests that the futures market is losing its ability to suppress or dictate prices, leading to a wild zigzag pattern that favors physical holders. Similar trends are evident in silver, where open interest has plummeted to 115,000 contracts, a low not seen since 2012. Further confirming this bullish structural shift is the performance of gold mining stocks. The HUI index remains near historic highs when priced in gold terms. Unlike the bear market collapses of 2015 or 2020, miners are currently refusing to decline relative to the metal, signaling that the sector is entering a robust, long-term expansion phase rather than a terminal top. Let's get back to the interview.
Gold allows you to be your own central bank. So this is an important part as well. Although a central bank is supposed to maintain the value and purchasing power of a currency, it has both the ability and the tendency to depreciate the wealth of citizens through excess money printing. Yeah, we know that. M2 is going through the roof again, but according to, and the Fed's balance sheet for that matter, but according to Jay Powell, the chairman of the Federal Reserve, that doesn't create inflation. Well, Mr. Powell, that is inflation. Interestingly, while they issue paper money, they also maintain gold as a currency reserve. Yeah, and they've been adding on massively in the last few years. That alone should tell you something. Central banks do not depend entirely on their own paper currency to maintain wealth. They use gold. Why? Well, one reason is because gold offsets currency risk. Well, you can ask Turkey, they've got a crappy currency, and yes, they've sold a lot of their gold recently, but it did the job, right? Anyway, let's continue. Through the retention of gold, an individual mimics the function of a central bank and therefore negates the detrimental effects of a central bank running its monetary printing press. It is why they own it, and they don't want you to own it, right? The controller of a nation's money supply can dictate the distribution of wealth and power within that nation. As the banker Meyer Rothschild once said, and I quote, "Give me control of a nation's money supply and I care not who makes its laws," end quote. Gold mitigates the power surrendered by holding a fiat currency. Gold is power. I think that's the most important point here. Gold is power. Gold is a hedge against the self-serving nature of governments. Again, ponder the power equation. Gold ownership passes the central bank function directly to yourself. In the spirit of self-reliance, it is better to be your own central bank instead of delegating this responsibility to a third party like the Federal Reserve or the Bank of England. Both institutions have a poor record in maintaining currency values. Yeah, definitely. And it hasn't improved since 2010. Gold takes the Federal Reserve out of your life, or the very least marginalizes it. Since the central bank is the primary controller of a currency's value and therefore your wealth. I'm going to stop here. There are other parts in this chapter that are really interesting. One is that gold cannot be produced ad infinitum. And that's really the major reason why it maintains its value relative to fiat currencies. But what I wanted to show you now is a few charts. And one particularly that is very interesting that I've been following here in the UK is the ratio between the average nationwide house price index to gold, to the ounce of gold. And the nationwide average house price index, that's been published since 1952. And up until this year, the low in that, well, up until late last year and earlier this year, the low had been 90.87 in 1982. So that's the least you needed to 90.87 ounces of gold that you needed to buy the average UK house price. And you can see here in the chart, right? And then the time that gold was the most undervalued versus UK house prices was 2004. You needed 672.09 troy ounces. So as of the end of February, and I did end of February because I don't think there's data yet from the nationwide for March. It will come out soon. So as of the end of February, though, that ratio has collapsed. It's broken through that 82 low, and it was at the end of the month at 71.31. So what it's showing here is that by holding fiat currency. Yes, house prices are still elevated in the UK, but they're not telling you the whole story. Gold is telling you the story that they're going to continue to devalue and debase the currency. And if you keep your savings in gilts or national savings or in cash, people think getting 4 or 4.5% is a good thing, but it isn't, because gold has gone up about 11% every year on average since the year 2000 in sterling. And there's another one that I look at, another ratio, and that's the Dow-to-Gold ratio. And that, of course, topped in late 1999, early 2000, above 40. So you needed 40 ounces of gold to buy one Dow industrial average. And now, though, it's, as we speak here on Monday, it's just below 10. And recently it got to below 9. Yes, gold has corrected down, and the stock market has remained relatively steady, even though it's been going down. But up until 2, 3, 4 years ago, it was trading above 20, and I think we're going to 1-to-1. And it's another example of how you really need to, even if you don't want to buy gold or silver, if you think it's too risky still, keep an eye on these ratios, because it's going to tell you that things are getting worse. And in the short term, of course, we're going to see fluctuations, but you shouldn't, like the book says, the risk is holding fiat currency, not gold and silver. I've stuck to these principles that I've spoken today for the last 10.5 years, and I'm going to continue to do so.
Owning gold is the most direct way to marginalize the influence of central banks over your personal wealth. While institutions like the Federal Reserve and the Bank of England have a poor historical record of maintaining purchasing power, gold serves as a sovereign reserve that cannot be printed ad infinitum. By holding physical metal, an individual effectively mimics the wealth preservation functions of a central bank, negating the detrimental effects of rapid M2 money supply expansion. As the adage suggests, controlling your own money supply is the ultimate form of self-reliance in an era of systemic debasement. The structural shift is best captured through long-term ratios rather than nominal fiat prices. In the UK, the house price-to-gold ratio has collapsed from over 670 ounces in 2004 to just 71 ounces today, breaking the 1982 historical low. Similarly, the Dow-to-Gold ratio, which exceeded 40-to-1 at the turn of the century, has trended towards single digits and appears headed for a 1-to-1 valuation. These metrics confirm that the true risk lies in holding fiat currency, not in the fluctuations of hard assets. Monitoring these ratios reveals the underlying reality. While paper markets remain steady, gold is the only asset that marginalizes third-party risk and preserves the power of your savings. Share your thoughts in comments section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive precious metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.